I think the way we think about it is just in terms of bucketing risk, right? If we're thinking it as a very large continuum with your buyouts on one end where it's less risky, more stable, but returns are going to reflect that, we're obviously going to put a little more capital there because we know what we're going to get back. As we go further down into growth equity and slide down to venture and then seed, we're always thinking about just our risk-adjusted return. So I think it's your standard portfolio construction in terms of how we think about that. But the interesting part is kind of within that. So how do you design your growth equity portfolio? How do you design your venture bucket? And I think what we've done to try and toe the line between managing risk, but also allowing ourselves to be able to reap some of the benefits of particularly like the venture portfolio is more of your core satellite type approach. So your more established names who may not get that 5x or 10x return on the fund level, but are much more of a kind of 2.5 to 3.5 type return, we'll start to allocate more capital to them. On the secondary or smaller players where maybe it's an emerging team, a more niche strategy where that kind of higher return is potential on the table, that's our satellite. So we'll have smaller allocations around that. And we think that is kind of bridging the gap of we're not going to be a binary outcome of a 0 or 1, but we're setting ourselves up for success over a longer term that these smaller nichier funds are probably and statistically have shown to perform better over longer periods of time than some of the larger funds. So that principle is held across this continuum of private equity,
Right.
And particularly within venture, we think about that, the risk management aspect of it very carefully.
Right.